Hey guys, I don't know if I guess I'll just keep going. So I'm going to be doing my stock valuation on AMC Holdings. It is the stock for uh, AMC theaters. I'm sure you guys have all heard of. So I'll just define them real quick. So they own and operate movie theaters in the United States as well as in Europe. But the primary source of revenue from them does come from the United States. To go up at the top here, first look at the price versus fair value. You can see that obviously in 2020 took a big hit and then was recovering in 2021 and then it's now on this downward trend. I mean, this is obviously evident in your price versus fair value. Pretty good, it was pretty good. And then 2017 and 2019, it was hurting. And then pandemic hit and it's really bad. You can see how undervalued the stock is right now in that blue section, which, you know, does have some investment potential. If I show you our operating and efficiency, so our gross margin was looking pretty good and still looking pretty good. It hasn't changed much. If anything, it rose in 2021. But our net margin, our profit margin, really was not doing good pre-pandemic and then got really bad in 2020 and then slowly recovering. We'll see that trend with other ratios, but this slow recovery is what we're hoping on. This is what I'm hoping buying would be beneficial for. The return on our assets, kind of the same trend, not looking as good as it could post or pre-pandemic, and then really bad in the pandemic, and then a little better in 2020, and then now we're a little better than that. So you can see that AMC's really been trying to recover, and maybe 2021 seemed like a year that they would, but it just didn't pan out how they would expect, which has led the numbers to still be negative, especially our profit margin. Shouldn't be losing money that much money at this point. Our interest coverage, same thing. We're really not able to cover any like short-term interest expenses or liabilities. I mean, this is just, you'll see a trend of AMC being short on cash. You can see our receivables turnover. Because I'm saying, oh, they're short on cash, I think they decided to really be hard on getting the money that they are owed because they need it really badly. Our inventory turnover has remained pretty well. I think this is to be expected from a movie theater company. I would see a lot of drastic changes in inventory that would cause massive fluctuations. Kind of similar in our fixed assets turnover, still positive. We're not as good as we were pre-pandemic, but we're getting back. And then same with our asset turnover. You can see the trend with our operating and efficiency is that we're slowly getting back. Maybe in the next year, we'll even be profitable. Obviously, our current ratio would really show us that like we are able to bounce back. In 2021. We even bounced back and we're really able to cover the current liabilities. But with a downtrend since then, it's gotten worse. It's almost as bad as it was during the pandemic. Our quick ratio, kind of the same. We were recovering, and then now we're kind of trend. Don't have any financial leverage with debt to equity for the pandemic on, which I think is a shame because I think that's where we're getting the majority of our value from, seeing like when in the last 3 years was it really bad and where is it a little bit better. And we can see this in the book value to share. Like we're still negative, but we're pulling out where we were in 2020. For the income statement, I mean, this hurts, but we're still negative. We've been growing revenue every year, which we love to see, especially since pandemic, since 2021. But we're still negative. We're less negative, but we're still negative. So we have a positive trend, but we're still in the negatives. Our price to sales, you can see how investors really lost faith with how much sales we could make. And now we're kind of looking better. We were really good in 2021 coming out of the pandemic, when maybe our stock price was a little overinflated, and we weren't doing as many sales as 2022. We're missing a lot of key values, key data points: the price to earnings, price to cash flow, and price to book. Obviously, we have the current, but that doesn't really help when trying to see 2020, 2021, 2022, and you can see we already kind of touched on this, but the return on assets, we were doing real bad in 2020, and they're starting to pull out a little bit. Don't have much data for our return on equity and invested capital. Let's see what else I want to cover. I don't think I mentioned the ESG risk rating. This is really just, I mean, it's low because as a movie theater company, the primary source of risk would be from customers, either something happening to customers on property, something like that. But a lot of businesses do carry that level of risk. I believe I talked about competitors. So you can see that maybe AMC isn't, from this chart, the best bet. However, with summer coming up, summertime is the busiest time of the year for movie theaters. That's when studios and theaters tend to put out the most, have the most people come, families, a lot of kids' movies come out in the summer. So the reason that I say to buy is because I'm hoping that in the next 3 months to 1 year period, let me find which one terms. So you can see for the 3 months, that's kind of like the optimal period for owning the stock. And that is kind of coincide with summer. So I could foresee this stock price increasing over summer when sales go up and investors have more faith in AMC's performance. But then that might dip at the end of the year. So this would be a relatively short-term buy. Let me think of anything else I wanted to talk about. I believe I didn't hit on the balance sheet. I mean, there's not a lot to say here other than we've been consistently having more debt than assets. We were pulling out the pandemic really well in 2021, but I think we didn't perform as well as we would hope, and that led us to 2022, once again, having more debt than assets. So obviously, we'll see, but I hope that my analysis makes sense to you and that you have some good reasons to agree with it. Thank you.